virtual currency hearings. Our next set of witnesses are going to be talking about a topic of particular concern to DFS, which is virtual currency commerce and consumer protections. Can both consumers and retailers use virtual currency as a payment system in a safe and efficient manner that benefits everyone? We look forward to hearing about the panel members' experiences, insights, and guidance related to this question and any others you want to talk about. Let me first welcome Fred Ursum, a co-founder of Coinbase, which is a virtual currency wallet company. Second, I'd like to welcome Jeremy Allaire, founder and CEO of Circle Internet Financial, which is also a virtual currency wallet company. And third, I'd like to welcome John Johnson, Executive Vice Chair and Corporate Secretary of Overstock.com, which is a major internet retailer that has quite recently started to accept Bitcoin. So thank you each for being here. I know you're all busy doing your day-to-day lives and your work, so we really appreciate you taking time out of your busy schedules to be here. As a formality, I swear everyone in before they testify, so if you'll each rise and just raise your right hand. Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth, so help you God? Yes. Thank you. So why don't we start with Mr. Ursum. We'd be pleased to take your opening statement.
Thank you, Mr. Losky, and members of the department for the opportunity to appear here today. My name is Fred Ursum, and I'm a co-founder of Coinbase, a company whose explicit goal is to make Bitcoin easy and safe to use for the average consumer and the average merchant. Prior to my current role at Coinbase, I worked here in the thriving financial community of New York City as a foreign exchange trader at Goldman Sachs, although my academic background is in computer science. Coinbase has become the trusted Bitcoin name in the United States because of this dedication to making Bitcoin safe for consumers and merchants alike. When Coinbase first began in mid-2012, no industry company was focusing on both creating a user-friendly interface to Bitcoin while also clearly regarding consumer protection, regulatory matters, and compliance as necessary elements to succeed in this rapidly evolving landscape. We have since invested disproportionate amounts of time, energy, and capital into exactly these areas. In consumer protection, we've taken measures like storing upwards of 96% of all Bitcoin on Coinbase securely offline, and instituting two-factor authentication on all Bitcoin transactions. To protect merchants from volatility, such as Overstock, we offer them the ability to instantly convert payments they receive in Bitcoin back to dollars, such that they don't need to take any exchange rate risk. On the regulatory and compliance front, we registered with FinCEN as a money service business within 2 weeks of their guidance in March of last year, retained top payments and AML and BSA advisors in their respective practices. Here is a proactive, not a reactive measure, and since have both crafted and adopted a risk-based AML program with a dedicated chief compliance officer who has extensive experience in emerging payments technologies from Amazon Payments to PayPal to Boku. We see Bitcoin as an extremely powerful technology for many of the reasons that have been discussed on the panels leading up to this one, and it is our goal to bring the efficiencies created by the Bitcoin network to the masses. In that vein, a safe ecosystem is essential in gaining and maintaining trust in any new technology, especially one that involves people's hard-earned dollars. As a result, we welcome appropriate guardrails to ensure that Bitcoin companies handling the money of others are run by reputable individuals and have appropriate practices to create a sound consumer experience. At the same time, we hope that regulation does not fundamentally inhibit the power of the Bitcoin network, which comes from its core innovation, the ability to transfer and prove ownership without the need for a third party. We are encouraged to see the department's proactive and forward-thinking approach to cryptocurrencies and strongly believe this is an opportunity to begin a trend for other states by setting statutes which require monitoring of funds entering and leaving the Bitcoin network for money laundering, but do not compromise the nearly free and instant transfers the network now makes possible. As an entrepreneur building what many of the investors on the first panel in Tuesday's hearings classified as a second-generation Bitcoin company, our goal is to make sure this technology, like the internet in the 90s, is allowed to flourish and bring all of its great efficiencies to the world in a safe manner. I look forward to engaging in dialogue with the department about how this can be best accomplished.
Thank you very much.
Superintendent Lawsky, thank you for the opportunity to participate in today's hearing. My name is Jeremy Allaire, and I am the founder and CEO of Circle Internet Financial, a financial services company aimed at enabling consumers and businesses to use Bitcoin and digital currency for payments and money transfers. I've been building internet software platforms and online services for 20 years, having founded and helped to lead multiple global public companies. Payments and money transfers are still operating in the pre-internet era. Digital currency has enormous potential as a payment method for both consumers and merchants. It offers greater ease of use, convenience, and security than existing payment networks, and at a significantly lower cost. Bitcoin specifically offers a powerful open platform that is global in scope and enables nearly instant, verifiable transactions at a fraction of the cost of existing electronic payment systems, while increasing security for end users and businesses accepting payments. As programmable currency, Bitcoin also portends to enable new forms of automated financial contracts and use as a globally verifiable ledger of ownership in nearly any form of asset. Without a doubt, there are currently many risks associated with digital currency, and many of these have been voiced by government agencies around the world, including price volatility, lack of consumer protections and safeguards around the potential theft of digital assets, the lack of consistent safeguards against seller fraud, and the potential for criminal use and abuse of a system that by design provides very high levels of financial privacy. We believe that through private industry and community-led innovation, as well as collaboration with lawmaking bodies, that all of these risks can be addressed and the innovation value allowed to flourish. We appreciate the leadership role that the New York Department of Financial Services has taken regarding digital currency and the efforts of the Conference of State Bank Supervisors and other federal and state regulators to review the benefits and risks associated with digital currency. We're also encouraged by the guidance issued by FinCEN last March, geared to ensuring that digital currency transactions are not used for money laundering and providing digital currency firms with much needed regulatory clarity on these issues. With that said, we believe more needs to be done from a regulatory perspective. The current state statutes are outdated and never contemplated technology such as Bitcoin. As a result, state regulators are finding it difficult to accept and process licensing applications for digital currency firms. We believe that there should be specifically guidance geared towards digital currency firms and that the states should develop a streamlined approach to licensing these firms. The growing global awareness and interest in Bitcoin is a testament to the innovation represented by this technology, and while there are clear risks, we see very strong evidence of industry and regulatory engagement needed to address these risks and allow for that disruptive potential of the technology to take hold. Thanks again for the opportunity to testify.
Thank you, Mr. Allaire. We'll turn to Mr. Johnson from Overstock.com.
Superintendent Lawsky, other members of the department, thank you for having us here. My name is Jonathan Johnson. I'm the Executive Vice Chairman of Overstock.com. Overstock.com is a publicly traded online retailer offering discount brand name, non-brand name, and closeout goods. We offer over 1 million different products on our site that range from furniture and housewares to apparel, electronics, to books and DVDs. We partner with about 2,500 suppliers nationwide that help us fulfill these orders. And we have over 500 customer service agents located in Salt Lake City to create a customer experience that consistently is top ranked nationally. Overstock's based in Salt Lake City. The company started in 1997 and in 1999 launched our website with just 18 employees. That year we did $1.8 million in sales. In 2012 we had over 1,500 employees and just over $1 billion in sales. We'll be releasing our 2013 results tomorrow. Our CEO is fond of saying that when we started, we were a lemonade stand with a computer attached, but that now we are a computer that happens to sell lemonade. In reality, we are a high-tech company in the retail space, and we employ a huge complement of developers innovating constantly and improving the customer experience. On January 9th of this month, we began accepting Bitcoin as a form of payment. The media is fond of reporting that when we focused on the Bitcoin opportunity, our CEO, Patrick Byrne, locked 40 developers in a room and slid pizzas under the door for 10 days until we went live with Bitcoin. That is not far from the truth, but of course...
It wasn't all pizza.
It wasn't all pizza. And of course, the work contribution was voluntary. I took from the last panel our next assignment, and that's to make sure we become a GSA contractor so that we can help the Department of Justice spend the Bitcoin that they have confiscated as they purchase office supplies and furniture.
If you'd ever seen their offices, they could use some help.
And we could help them save, so that's good. Overstock is the first and largest major internet retailer to accept Bitcoin. On the first day, Overstock conducted just under 700 transactions for a total value of about $130,000. Since announcing that acceptance on January 9th, we've conducted nearly 3,000 transactions valued at over a total of $600,000. We're often asked how we handle the fluctuation in Bitcoin value. That's a good question. The answer is we immediately broker the transaction with a Bitcoin broker, Coinbase, and immediately exchange the Bitcoin we receive in any transaction for U.S. currency. Thus, our Bitcoin currency risk is next to non-existent. Some have asked why we would accept a cryptocurrency at all. Again, I think that's a fair question. Our answer is that we are merchants, and we are willing to examine any practical form of exchange where we can sell product and receive value in return, so long as we can manage the logistics and risks of that medium of exchange. Bitcoin has presented just such a manageable opportunity. I look forward to answering your questions.
Well, thank you very much. Very interesting testimony from all three of you. We have a lot of questions. Let me start with a general one. I'd like to just get the opinion of all three of you, since you all work really at the cutting edge of the intersection of this new technology with the consumer experience. We had a debate yesterday about what phase we're in the development of Bitcoin, and regardless of what phase you choose to call it, I'd be interested in get your opinions on if you could each predict where will we be vis-a-vis your work and vis-a-vis Bitcoin a year from now, let's say.
Sure. So I very much agree with sort of the phase mentality that was laid out on the investor panel yesterday morning. I think that, and we've seen data and fortunate enough to operate a platform where we have a viewpoint into this, where we can see on the ground that we are very much and have been going through what I would deem as sort of a speculatory phase, combined obviously with technological innovation to bring early stage infrastructure companies sort of up and understanding how to properly serve this extremely powerful technology. I think there are a couple of indicators of that. Overstock.com, I think, is a very bright beacon in this going from largely speculation, and in some cases rightly so. I'm not afraid to admit that when I bought my first Bitcoin, I thought the value would go up because I saw the value of the technology and of the network, and I thought that network would be very valuable. Now I've gone and I've spent some of my Bitcoin at Overstock. So I think one great beacon here is major retailers like Overstock, and there have been others, hopping on board. And knowing what we are fortunate enough to know at Coinbase, there are many others of similar stature in the pipeline. I think another interesting data point here is simply looking at the demographics of this. So if one is to go back and look at the demographics of Coinbase users, 6 to 8 months ago, it was 93% male, and as one might guess, younger individuals, sort of a typical early tech adopter crowd. Although we're certainly not all the way there, you look at data from a month ago, and the percentage of females and percentage of sort of older demographics has almost doubled in that period of time, albeit still small. So from the ground, it seems that all things are moving from early speculation, early building, towards a bit of an inflection point in mainstream commerce.
Would certainly concur with a number of the comments from Fred. We internally, sort of as we articulate how we look at the market and the arc of the market over the next, even 5 to 10 years, we have the first box, which is where we are in time today, and we call that the I want Bitcoin phase. And that's really, again, underscoring this desire and interest of retail consumers and increasingly even institutional investors in this as an asset class, being very interested in owning it. And the way I've put it publicly is effectively the growth in the value of Bitcoin as a put option on its adoption as a payments platform. And so I think we're now really just starting to enter that phase of Bitcoin as a commercially viable payments platform. And I would certainly think a year from now, we would see a great deal more both online retailers, but also in-person sort of point-of-sale retailers that are beginning to adopt this and experiment with it. We've certainly seen very significant inbound interest from businesses that are compelled by the opportunity. But again, I don't want to overstate where we are from a phase perspective. I think really just in the last few months, which saw this price appreciation, that was very much driven by this sort of media awareness and interest and driving up that speculative value. It's been encouraging to see price stability for a few weeks at least, and that I think is helpful as well. I also want to underscore another point that Fred made, which is that I think that for retail consumers, conceptually they're taking savings and they're putting them in a digital asset. And that's what that kind of quote-unquote investment is. And I do believe that as the utility value is surfaced more easily, where the kind of applications that we carry around in our pockets and the businesses that we interact with and other counterparties that are even consumers, friends and family, have those same applications, that as that utility value increases and becomes easier, that people who've bought Bitcoin and are holding Bitcoin will begin to spend that much more freely. And it's something that we look very closely at, is trying to understand, looking at transaction volumes and activity in Bitcoin and how much of it is associated essentially with transactions on exchanges versus transactions that would be between businesses and or between consumers. And it's still quite small, obviously.
But do you think over the next year you'll see a significant uptick in the latter?
Absolutely. I think there are multiple companies, certainly in the U.S., but I just spent a week in Europe, and the number of new startups that are focused on servicing the business needs, merchant needs, consumer needs is really astonishing. It's happening all over the world. You're seeing that open up, and that's very exciting for our businesses as well, in that that's part of the promise here is a global currency model that's internet-based, and so you can transact both online and offline with merchants all around the world with that same efficiency and security and performance as well. I would say there are issues, and we've spoken publicly about this, that I think can limit that. Some of that is the lack of clarity around regulatory requirements of money services businesses in the space, and obviously we're here today discussing that with you. But I also think the lack of clarity around the income tax treatment or the tax treatment of Bitcoin is a very fundamental issue that will affect broad-based merchant adoption and or consumer adoption. Without that, it is not viable for the accounting departments and the people who perform general ledger operations and the people who ultimately account for taxes and take care of those. If that's not there, we will not see this have the kind of adoption that it can.
It's funny, it feels like beyond the dealing with the money laundering anonymity risk and addressing that as regulators, it feels like the number 2 problem that has to be addressed soon is the IRS tax issues.
I would agree with that.
Mr. Johnson, if you want to take that first question.
Yeah, we feel like it's, when you ask what phase it's in, we feel like we're in an early acceptance phase because we're now accepting payment and doing orders that way. Where do we see it in a year? We hope that some of our suppliers will be accepting Bitcoin so that we can not immediately convert it all to dollars, and we can pay our suppliers in Bitcoin. That would allow us to hold and spend rather than immediately convert. just anecdotally, I was getting my hair cut this weekend at my local sole proprietor barber in Holiday, Utah, and she asked me, tell me about Bitcoin. And I'd noticed that the previous patron had paid with a credit card, and she said, I would love to have something that didn't have interchange fee, where I wasn't giving 3% of every haircut to the credit card companies. So I think both large and small businesses have a real incentive to add, 2 to 4% to their bottom line or pass on to the customer. And I think as adoption increases, I think at some point we'll reach a tipping point. And like the internet was an unknown in the early and mid 90s and ubiquitous today, I think that's where Bitcoin could be. And whether that's 12 months or 36 months, I think it will happen.
We can have less of a haircut for the haircut.
Yeah, less of a haircut. Very good. Very good.
Couldn't resist, sorry.
Yep.
Can you each talk a little bit? I mean, one of the big questions out there, we just had a law enforcement panel, I don't know if you heard it, is about anonymity. And I think it's something that retailers or wallets or other services obviously have to care about a lot as well. How do we've had now two main sets of testimony, one side yesterday saying there's no real anonymity when it comes, for example, to Bitcoin. You have the public ledger, you can track all this back. And the prosecutors today saying something at the very least that's in tension with that it's depending on how the software is set up and what kind of procedures different businesses put in place, whether it's a tumbler, whether it's something else, it can make it exceedingly difficult for law enforcement to track back who is doing what. So as businessmen, I assume you have to face this question as well, and I would just like to get your respective takes on that.
Absolutely. So this came up in the first panel, the investor panel yesterday as well, and it seems to me that, as was stated, there is a bottleneck here. That is the on and off ramps to the system. Coinbase is definitely one of those. I see it as our distinct responsibility to, just as any money service business, follow the appropriate AML guidelines and have an appropriate risk-based program to make sure that for the traffic that we may facilitate into and out of the system, we're comfortable with those flows and we perform all the diligence that any firm dealing in people's money is expected to perform. So that includes a relatively extensive Know Your Customer program, an AML program with a dedicated chief compliance officer, and I would hope that other industry participants also follow that model.
And you find that requiring that level of information from your customers is not hurting your business?
No, not at all. I mean, there are some, frankly, and this applies to any technology, who, if they really want to use it for fringe reasons, they will go to venues where requirements are the least stringent possible. That is not at all our goal, and generally speaking, I think regulation could be a positive thing in this regard, because if there is a framework around which companies who are performing exchange services are required to perform this set of due diligence or enhanced due diligence, as the case may warrant, then we really effectively filter that bottleneck, if you will.
So first and foremost, Circle is registered with FinCEN. We are investing aggressively in compliance programs, Know Your Customer frameworks, and AML programs. So we certainly agree with the view that exchange operators, whether it's a kind of consumer-focused business or a investor-focused business or anything in between, have those obligations. I would also say, though, that there is a sort of, and I mentioned this in my comments, there is a sort of fundamental value around financial privacy, and financial privacy is a very important concept, not just in Bitcoin, but in other financial transactions and systems. And so, for example, in a public ledger system, if I'm a business and I have addresses I'm receiving funds at, well, then my competitors have the potential to understand how much revenue I'm receiving. Or if I'm a consumer and I give out a public address and I'm getting paid income for that, then people can effectively have a means to spy on my transactions. There are methods to deal with that, certainly in a software service or within software, but we have to also respect that financial privacy is important. In the e-commerce scenario as well, I think that there is a perception that in card network platforms that the use of personal identifiable information can then be used by marketers and others in ways that consumers might not want. And so I think we have to think about all these issues when we think about the identity-related factors involved in cryptocurrency transactions. And I think, in fact, and I've made this point before, the sort of security model of making a digital payment where you're using private keys to sign a transaction and send a message and have that processed by the network, that is more secure and more fraud-proof than existing payment methods that we have today. And that's a real consumer benefit, and it also supports consumer financial privacy, and I think those are worthwhile goals to support.
If we, let's assume all of that is true, that it's better for consumers not to have their personal information sitting out there with a third party if they don't have to, and it's nice not to have to be, for most people, marketed to buy 10 new websites the moment you buy one thing, and now everyone knows what you bought. Assume all that's true. How do you square that with, I'm sure, all of our desires to not allow virtual currency to be used in a way for people to take advantage of that financial privacy to get involved with illicit activities?
Well, I think the key is exactly what I believe the money transmitter regulations are designed to deal with, which is that consumers that create accounts with these companies are required to be vetted and their identities established and the transactions audited and monitored for suspicious activity and those identified, and to be compliant with subpoenas from law enforcement in the event that there is believed to have been a crime or financial crime. So all those make perfect sense to me, and those, I believe, are sufficient safeguards for that, but at the same time allowing the users of those financial products from a commercial perspective to have a little bit more control.
If I may, let me put this maybe into a concrete example that Jeremy very much alluded to. So take the example of making a payment with a credit card. In order to make a payment with a credit card, one must hand over one's payment credentials, including the card number, which ultimately is what a subsequent payment can be made with, to the merchant or to the payment processor. That fundamentally is the issue, and that number getting out and those payment credentials getting out is what allows further fraudulent transactions to occur. The piece in the background that we're all worried about, obviously, on the money laundering front is, are we comfortable with the transactions that are occurring? And in either case, the credit card company, knows what's going on. They see the dollar volumes. They know their customer, et cetera. It's just the piece of the credit card number, again, the payment credentials that allow further payments to happen, being exposed at all times is the fundamental issue, which in Bitcoin is fundamentally eliminated by the technology.
But so in that hypothetical, say it's your company, are you standing in the shoes of the credit card company?
In that case, yes.
Okay.
Actually, if I can just follow up. So in your world also, that would be kind of, do you see heightened protections in around the keys, around the private key?
That's exactly right.
Because that's sort of the equivalent of the credit card number.
That's right. The fundamental difference here, obviously, is that in Bitcoin, the private key need not be exposed. It's only, and due to mathematical and cryptography properties, one can verify that a payment truly came from a given address, but one not need expose that private key in order to prove that, in the same way that one needs to hand over a credit card number to facilitate a payment.
Mr. Johnson, we never got down the row.
No, that's okay. I'm happy to be the cleanup hitter. For our customer, no one is completely anonymous. They are always providing an address for us to ship to. In theory, that address could be a abandoned warehouse or someplace they're not. They're generally supplying an email, but so for us, people need to identify who they are to get the product, and I think that'll be true in any online commerce because they can't just pick it up. I also think that transactions done with digital currency are more trackable. Going back to the anecdote of my barber, I paid her in cash, and I assume she'll report that, but I don't know. It would seem to me that revenue agencies could probably be able to monitor transactions better when they're all collected digitally. And as far as the fraud risk, I'd like to give you some statistics about Overstock's anti-fraud prevention. We have a fraud prevention. It's not an anti-fraud prevention. I get the double negatives there. We have a fraud prevention department which screens roughly 14% of the orders that come to our site. So they just screen those. So if we think that an order on your credit card looks mysterious, we will call you and say, did you indeed order these bed sheets? And our customers like that. We cancel approximately just under 2% of orders. So you can see about 14% come in and 2% are canceled. Despite that, we lose about 18 basis points a year in fraudulent orders, where the credit cards come back and we refund the credit card for orders that was fraudulent. I think the risk of that with Bitcoin goes way down, and so we will not spend as much in that department if it becomes widely adopted, and we think we won't lose as much to fraud.
And has that been your experience so far? I mean, I know it's young, January 9th. It's only
hard
2
to
weeks
tell.
old. Yeah.
I think so. The other thing that I think all retailers worry about in the post-Target and Neiman Marcus announcement world is having customer credit cards and personally identifiable information hacked. So far, it's always been with just point-of-sale companies that have come in the news, but I think the protections in the cryptocurrency make that much more unlikely, and therefore, we hope lead to adoption.
Can I change the topic just briefly to price volatility? You mentioned it a little bit. I understand that the way to deal with that today, if you're a retailer, is to immediately exchange the Bitcoins you get right into whatever currency, fiat currency you want. Some of the testimony I've read in the lead up to this hearing has said that because there's not that much use yet of virtual currencies, that having that immediacy in the exchange back to a fiat currency is not all the way there yet. I mean, is that not the case, or is it because you're using Coinbase? Just wanted to get your take on that.
It is the case for us with Coinbase. So, I mean, like I said, we have next to no risk. I think our risk is something wrong happens with Coinbase, which we're not worried about. We do anticipate a day where we are either keeping Bitcoin to pay vendors or we're keeping Bitcoin as an investment. But today, in our early adoption, in our early acceptance phase, we convert it all to U.S. dollars.
I think it's worth noting on price volatility, sort of where we are in the evolution of this market. If you step back and look at it today, this is a highly immature market with highly immature exchanges, most of which are operating offshore, with a total daily trading volume that represents a single small cap stock on a single exchange, and mostly driven by retail investors. And so in an environment like that, low volume, low float, and immature trading products that are difficult to interact with on a worldwide basis, it is not a surprise that we have the volatility that we see today. I think, from my perspective, the single most important thing that we could do, and that's sort of collective we, is get some serious exchanges established here in New York that are focused on being mature trading platforms that are able to be used both by retail investors, but also by large institutional participants. And rather than having the market maker and liquidity provider for Bitcoin be a 14-person company in Slovenia, have it be a well-financed and capable platform that is both closer to the oversight of New York and federal bodies, but also can provide a more mature trading platform. I think with that, we will see greater volume, greater liquidity, more sophisticated pricing tools, derivatives, hedging, et cetera, which will allow price volatility to subsist a great deal. And so from my perspective, that's really the core issue.
Do you think that's going to happen, and what do you think needs to happen for that to happen? You can take those in whatever order you want.
Well, it's very much related to why we're here, which is I think we need, for those exchanges, they need to clearly understand what their obligations are from a license requirement perspective, whether that's a money transmission license or oversight from CFTC or others. And I think if there is clarity there, I think there are plenty of entrepreneurs, including I'm sure some in the room here today, and I certainly know very high quality private equity and venture capital and other investors that would invest in and build those businesses. I expect there are multiple that are underway that we're not even all aware of, but I think, or some of us are, but I think that's really a really critical step. And I think that's not just here in New York, that's in London and in other markets as well that can support this on a worldwide basis.
Let me just ask, though, because it sounds like this is a little bit of a chicken and an egg problem. I understand that from what you said that there are more major retailers perhaps in the pipeline and in the near future. Are we looking at a potential liquidity crunch? Because given the statistics that we know that so much of Bitcoin is held by so few people, and that we're, according to testimony yesterday, largely in a hoarding phase, it may be that it gets too successful too quickly. So what's going to happen when you got a lot of people rattling to use Bitcoin? It sounds like your protection against a currency risk is going to be in jeopardy. You may have to convince merchants and vendors to take your Bitcoin sooner than you think. Are we at a phase where we should expect that there will be such a crunch? There have been, minor episodes of that already.
Yeah, no, it's a good question. In my opinion, the sort of real commerce activity at the moment, admittedly, is one might say 10 to 15% of actual volumes occurring over the network, whereas speculation accounts for the remainder. That being said, I think if that's really true, one should expect volatility in the near term. In terms of a reasonable means for payments, any given payment example, I buy a toaster for $40 on Overstock. I don't think there's any real liquidity issue there. That's a very small transaction, although as Jeremy noted, the liquidity is very much similar to a single U.S. equity at the moment. I'd like to underscore Jeremy's point that I personally know many entrepreneurs who are looking to create futures, options, exchanges for Bitcoin. And we are, as coming from a former bank where I traded foreign exchange, one can very much view this as a nascent asset market. One looks at the developed foreign exchange markets, and there are all sorts of derivatives which help everyday companies who operate in many jurisdictions hedge their risk in an appropriate manner. And the same, I think, will help the Bitcoin market and companies like Overstock or other industry companies in dealing with that exposure. The other thing I think is important to note here is there is, albeit at sort of the early stages, a shift away from speculation and towards actual use. And just like any currency, just like the euro or the dollar, as a percentage, as use goes from speculation towards real economic underpinnings, if you will, real commercial transactions, stability naturally occurs over time.
I think another related point is if you think about the sort of Bitcoin asset as it is today, it's a $10 billion monetary base that exists today. I think if we can imagine a few years out that this is a more mainstream payments platform that's used on a worldwide basis by a wide variety of types of business, both for retail and business-to-business payments and so forth, the monetary base needs to grow quite a bit as well, from perhaps sort of capitalization of $10 billion to $100 or $500 billion. And as that happens, I think certainly the ownership gets, I think, much more evenly distributed. I think that the liquidity that you see will be dramatically stronger, and then pricing stability as well. And so we're in a build-out phase, I think, as a kind of underlying asset class and payments platform.
My view on a liquidity crisis is that could happen, but because Bitcoin's infinitely divisible. I just think it's going to affect the price, and the cost of a toaster on Overstock, instead of being X percent of a Bitcoin, will be a much smaller percent of a Bitcoin as the price goes up. I mean, liquidity, price should will factor in liquidity, and it could, in such a situation, go higher because of the speculative nature, but I think it will, with adoption, it will all kind of land where it's supposed to land.
For the time being, without just responding categorically rather than specifically, where are you folks getting the big? Thank you. Sorry, it was on. Where are you folks getting Bitcoin? I mean, there are limited sources of it, and we understand from written testimony that, for example, you get it from retailers who want to trade it back. You get it from miners. But what, again, categorically speaking, what are your sources?
So generally speaking, we are fortunate enough to operate a platform that sees many aspects of the ecosystem. So that means consumers who wish to both buy and sell Bitcoin, and retailers, much like Overstock, who are natural sellers of Bitcoin as they hedge their exposure back into dollars to realize real revenue for their business. So it turns out that the vast majority of our flows simply offset themselves. There is sufficient liquidity in the market to offset that small remainder, which can be obtained from many of the sources you just noted, those being early adopters, as you noted, happen to have a lot of Bitcoin because they got in early on. Miners are another good source, and again, they are quite literally a natural source of flow of Bitcoin into the ecosystem, and that really is able to make up for the remainder.
And do you, with regard to miners, and you gave a very comforting description of the emerging regulatory AML, BSA compliance programs that you're putting into place. Do those apply to those folks who are providing the inflow?
Absolutely.
So when it comes from the mining community, because as we've been advised right now, that is largely anonymous. Are you able to identify who you're actually dealing with?
Yeah, I think we should separate maybe what might be a couple of different distinct concepts here. So one is a customer performing a financial transaction with Coinbase. That is somebody who we know well and
Yes.
have vetted. Mining as a system, it's not necessary that all miners come to Coinbase. They very well may go elsewhere. They may just mine out of their own interest and hold Bitcoin. It's not to say that all miners come to us, right? So there are portions of that we certainly don't see.
I guess my question is, as to those portions, though, I appreciate that, and that's why I asked whether it was just inflows or your transactions that you're dealing with. You can identify some. We really are trying to understand, are there still, crevices out there in the ecosystem that you're getting stuff from, but you don't know?
So on our end, and we haven't launched fully commercially yet, so I can describe this at a high level for you. All sort of supply side counterparties are fully vetted from a know your customer perspective. That also means that we won't do business with certain exchanges that exist in the marketplace today because they do not have sufficient know your customer policies themselves. So there's a known exchange that's based in Bulgaria. We won't do business with that exchange because of that concern over the counterparties that they're interacting with. But if there's a miner or an institutional holder or a large individual holder or an exchange, all of those have to be vetted from the sort of supply side.
I don't think the question really applies to us,
Right.
but I'll answer it. They're from the nearly 3,000 customers that have purchased stuff, and I would note that most of those are new customers to Overstock. So, we've seen this acceptance as a way to market to Bitcoin holders and enthusiasts.
Sort of a technical question from my limited mind. If I come to you with Bitcoin and want to buy whatever it is, bed sheets, as you said, at Overstock, if I then decide I want my Bitcoins back in a refund, what do you do? Do you just sort of reverse do you have to buy Bitcoins back from Coinbase, or do you say, sorry, your refund's coming in cash, dollars?
Our terms and conditions provide for in-store credit for the returned bed sheets. Now, if it was our fault, something was wrong with them, and you decide you don't want them, our terms and conditions provide for a refund of the dollar amount in Bitcoin that as it is on the day that the transaction, the refund is done. So it's not a way for you to have an option on the Bitcoin market.
Something we've seen many times on the ground, yeah.
Bed sheets shouldn't be your option tool. So.
Right.
Yeah.
Right. Do you ultimately anticipate? We had some testimony in the second panel yesterday from other currencies, about other currencies, not just Bitcoin, and we had a discussion of whether we're in there can be only one world, or whether we're going to be in a world with multiple, at least a small number of different currencies. Do you anticipate Overstock.com taking more than just Bitcoin?
I can see us doing that, and I don't know if this turns into a Betamax VHS comparison or a iPhone, Android, BlackBerry comparison. And but as there are, we're a merchant, and if we can receive something of value in a risk-free way for our products, we will.
Give some of my colleagues a chance to ask.
For Mr. Arsom, you've discussed the AML policy for a individual who wants to open up a wallet with you. But I'm curious what steps you take in the onboarding process of a merchant to verify their identity, and do you require that they have a wallet with you, or can they set up, in essence, an anonymous wallet someplace else that could be potentially unconnected?
Based on the way the platform works at the moment, they're actually one and the same. So in order to receive payments, as in Overstock.com or others, we, by sort of virtue of the way the flow works, one must have a wallet on the platform. So those are not just two distinct elements. The merchant onboarding process is much like you would expect from a credit card company, let's say. Who are you? What's your general course of business? As a result, what might a normal course of payment flow look like? And if it's something outside of that, then maybe there's something wrong.
And then do you require that coin be spent within that ecosystem if someone has a wallet with you? Or can they spend it outside of that ecosystem, and therefore you don't know exactly where it's going?
That's a good question. I think one of the fundamental issues here is how do you know, or what steps should be taken to ensure the safety? Is it regulating the edges, so to speak, or the conversion points, or is it stuff in the network? At the moment, we are looking at the edges. So should somebody want to cash their Bitcoin out as a merchant, we know who they are, we know what their volume is, obviously, and based on the business that we are in and what we know about them, we can make some sort of risk-adjusted decision as to what might be appropriate or not.
I think it's worth noting on that the sort of know your counterparty issue does remain one that has been raised in a lot of our discussions with regulators. There's I think a particular concern around OFAC screening and the fact that counterparties in Bitcoin to Bitcoin transactions can have very large transaction size values, and there is no awareness of the geographic location, name, address, or other information of those counterparties. So unlike a wire transfer, there are not controls at that level, and that is an issue that exists in the market today.
And your thought would be that, at least for now, the check would be on when one of the counterparties would want to come to an exchange.
That's right. So essentially, we're regulating the in and out points of this platform, in a sense. That really does require consistent approaches to sort of BSA level provisions on a worldwide basis for that to be effective. If you don't have consistent approaches on a worldwide basis, then you're going to have the leaky valve syndrome.
You mentioned the worldwide basis, and sort of we've had a couple references to the global nature and the real advantages that virtual currencies bring. I can tell you we have a webcast going on of the hearing, and we had viewers yesterday from 108 different countries. which shocked me. I mean, I know we'd have other countries, but not 108 of them. So I wonder if each of you could just speak to, I think we know the benefits of that, but any unique challenges that your companies face as a result of sort of the very global nature of this market.
I think very much as we're speaking today, one is regulatory. This is a very complex issue. It touches a number of areas, including taxation, AML policy, classification as currency, commodity, security, or otherwise, maybe some combination thereof. And in a system, Bitcoin is, again, the core innovation of what makes all this so powerful is it's frictionless and it's borderless because it's moving bits around in an efficient manner that was never possible before. That does not map one for one to how various nations deal with this. And at the moment, even states, although I hope that we can set a positive sort of tone and then hopefully others can learn from that. So as an industry company, that is obviously a great challenge, one that I know Jeremy has very actively been looking at as well.
Yeah, I mean, I won't gush about the global opportunities. I think they are obviously absolutely dramatic in terms of the potential for deeper economic integration and more frictionless forms of trade and interaction on a worldwide basis. It's a very exciting prospect in the same way that communications, media, and commerce platforms have sort of evolved and emerged on this open, decentralized internet platform that we all take for granted every day. I think the way we think about this is that for the foreseeable future, digital currency is sort of living in a hybrid kind of digital / non-digital economy. I think that there are probably proponents of digital currency who want everything to happen inside of that ecosystem, but the reality is that's not likely to happen anytime soon. So within that hybrid model, every single jurisdiction has got a different set of classifications on types of financial or non-financial institutions, regulations on consumer protection, refunds, theft, anti-money laundering provisions, taxation, all these items that have been discussed. Certainly jurisdictions like the EU actually create a framework from a legislative or regulatory perspective that is potentially more straightforward, but in fact, when you get, the rubber meets the road, German law is different than French law, is different than Nordic law, and so on and so forth. And so it is very complicated. But I think this is one of the first major internet technology-driven issues that really will require collaboration on a worldwide basis. We don't have to collaborate to figure out how to make SMTP work or HTTP work, but because this touches financial systems and central banking systems and the like, it's going to require a degree of coordination to enable it to really take hold.
For now, we only accept Bitcoin on domestic orders, and that's just a matter, I think, of programming and building it out. We also don't accept it on mobile orders yet, but that's, again, just a matter of programming. We see this as an opportunity to expand the customer base. We have a lot of trouble accepting international credit cards. That requires a lot of development and greater fraud risk. We think this Bitcoin payment method should eliminate that when we're at the point of accepting it internationally.
If I could get back to your discussion of the developing... If I could get back to your discussion of the developing compliance systems that you are working on now. Yesterday, I wouldn't go so far as to say we heard, sky is falling testimony about what might regulation do to this nascent market if we require too much of small emerging companies. Has it really been a disincentive to development? Has the cost of putting this in place been something that has been a large hurdle, barrier to entry for you folks to develop?
So I think our example might not be the best in illustrating this, but I'll try to answer your question in the best way possible. So we've been fortunate enough to receive a sizable chunk of funding from one might consider some of the top venture capitalists in the world. As I mentioned in my written statement in the opening, we've spent a disproportionate amount of that capital, as well as our time and energy, into investing in compliance because we viewed that things would get to a point where we're sitting here today, and these are really paramount issues. That being said, you can imagine other technology companies, you compare this to a social startup or something of that nature, where it could very well be two guys in a garage trying out something and seeing if it goes viral in some manner. Obviously going and getting licensed in 47 or 48 different states and spending the $1 million+ in bonding and legal fees associated with that and application fees is quite onerous. Although I love Fred Wilson as our Series A investor, I think there probably is some minimal set of requirements that needs to be done here, because once you open up a business that starts moving money around, bad stuff can happen right out of the gate. So there needs to be some minimal procedures there if you're facilitating that exchange. That being said, I think there is some sort of reasonable gradient that could be accomplished here where, as a company maybe performs more transactional volume and that sort of risk goes up accordingly, that maybe there's some scaling in the requirements imposed by the state.
I would echo a lot of what Fred has shared as well. You know, when I founded the company just under a year ago, I knew I needed to raise a lot of capital because as a regulated money services business, the investments required to do that, not just in legal fees or surety bonds or the like, but just overall the investments around risk management at a systems, people, process level, technology, et cetera, we expected to be significant. And continue to be significant as we have, you know, broad ambitions for the company. And so I think there is a sort of higher sort of threshold here for a financial services company that is handling consumer funds and protecting those funds and protecting against criminal abuse of those platforms. But I do agree with the view that there may be some way to think about, just as you know, financial services firms take a risk-based approach to the problems that they have or the systems that they're implementing based on the nature of the business, the customers, et cetera. There may be a risk-based approach that could be applied to licensing on companies in this arena. I'm not sure what that looks like. It could be, you know, today there's sort of a floor on surety bonds. The underwriters of those expect a certain level of capital and collateral and management expertise and all these things. And if you know, every single startup had to achieve that, that is a significant barrier. I would say the other major issue, and this is something that I also submitted in my written testimony, is, you know, I think we're at a place not only where, you know, a Bitcoin-based MSB is by nature national in scope as a pure online service. It's also international in scope, just the nature of this. And a lot of my impression, the original money transmission, you know, statutes were really designed around interstate types of money transfers, really not contemplating the global internet. And it strikes me that this industry would benefit greatly from a highly coordinated approach amongst key states at a minimum, if not all major states, through the Conference of State Bank Supervisors. And I would encourage this sort of forward-leaning posture that New York and a few other states are taking, and really trying to understand this and try and refine what those license requirements would be, instead of sort of acting unilaterally, really trying to work to establish a common license model through the the Conference of State Bank Supervisors, so that startups have a very clearly defined license model that doesn't vary dramatically from state to state, and also a common, consistent, and streamlined examination process that would be consistent as well. I think that would benefit this industry a great deal. And again, that's really not something we can control. That's really up to the financial oversight authorities in key states such as New York and others.
I'll just let you know, we are talking to other regulators. We are talking to CSBS. I mean, I think it's important. They're actually, I'm not going to dime them out, but they're here today. They were here yesterday. And I think that relationship between each regulator and the conference is very important.
That's great. That's excellent to know.
I don't think that question really applies to us, but the lack of regulation made it easy for us to be an early adopter as a merchant. And I think that the more regulation that gets put on at least the merchant end, the more likely we are to quash adoption. And I think that's not a good idea.
I'm not sure the concern is focused so much on the merchant end.
Right.
Generally, I haven't heard that or read that anywhere, but maybe it does have, maybe there's a question focused somewhat towards you. You know, in other emerging industries, there has been substantial support by vendors. A lot of vendor financing goes on because they see the potential going forward. It sounds like a protocol, a system. Yesterday, someone even suggested that there may be outsourcing of some of these kind of BSA, AML services. Is there any sense in the retail industry that it makes sense to come together and kind of help this along? Because in the long run, it's going to be financially prudent?
You know, we have not been involved in that discussion, although we'll have our annual supplier summit in Salt Lake City, and we will have Coinbase there to explain what Bitcoin is, and you know, we would like to see adoption, and so we'll be advocating for that. But I'm not aware of an industry, you know, like the National Retail Federation or other industry group that's actively involved in this.
Totally unrelated question. Do you think that your company's use of Bitcoin or acceptance of Bitcoin is going to drive your competitors to do the same thing? And are you seeing that yet?
We haven't seen it yet. We hope not. We'd like to have cornered that piece of the market, but I can't imagine that anyone will let us corner that. So I would think it would.
But from your retail perspective, what are the greatest risks in transacting in virtual currency?
You know, we think it's a lot less risk-free than a credit card. We have cash immediately. There's not a 3-day period to get it. There seems to be less fraud risk. You know, I guess the risk is liquidity, and you know, will Bitcoin be immediately exchangeable for dollars? And today the answer feels like it's yes.
Mr. Johnson, I think I know earlier you said that you felt the risk was fairly sort of non-existent to your company. You kind of sort of set out why and talked a bit about dealing with Coinbase. And I guess from a retail perspective, when you were going to be dealing with Coinbase, Mr. Ursum's company, what is it that you were looking for that brought you that kind of comfort? Like, what makes a good, secure wallet?
Well, we talked to several wallets. They were well backed. Their venture investors are impressive and smart people. Their security systems are good. They said they would and have been easy to work with. You know, getting something live in 10 days is technological miracle in my experience. And anyway, I think it's ease of use and knowing that we would be paid.
Yeah, and just to maybe quantify the risk a little bit, you know, liquidity really is not a huge issue when you're processing the everyday consumer payment. This is also being done in a manner at the moment with overstock, and the hope obviously is this trickles down the supply chain and we see this beautiful frictionless payment world be able to facilitate free-ish, as it's been termed, transactions for all people involved. But at the moment, it's a daily cash out thing. So the absolute upper bound of this risk is a portion of a day's orders if all things were to fall apart.
Right. Small.
Mr. Johnson, you previously said that you could envision a future where you would retain a certain amount in Bitcoin. And I'm curious, from Mr. Ursum and Mr. Allaire, I'm curious if you've received, if you feel that other companies will act similarly and retain a certain amount in Bitcoin.
I mean, you certainly have a view. You know, I expect that we'll see that grow over time. I think There are certainly merchants who are interested in this both for the economic and security and kind of fraud risk benefits, but who also believe it's a very interesting model. And you certainly are seeing merchants that have international employee bases, suppliers, others, where there's a material benefit to potentially using Bitcoin within their value chain. That is going to grow very slowly and incrementally, but I would expect in years that could be a significant amount of transaction volume being held and used on balance sheets for businesses for a variety of reasons. There was actually a survey published, I don't know the quality of the data, yesterday or the day before, which was of roughly 2,000 technology professionals, and the results were that of those 2,000 technology professionals, 51% said that they would elect to receive payroll and income in Bitcoin. Now, that's not surprise, early adopting technology professionals, and they didn't say if it was all of their income or 2% of their income or what that was, but it shows an interest amongst the potential for businesses to use this as a mechanism of payment. And obviously there's payroll services that are beginning to experiment with this in a variety of ways.
And this is actually happening on the ground. One of the main use cases we saw early on in this was for web services, paying international contractors to build websites overseas.
Changing topics yet again, we talked yesterday at the hearings, and Mr. Allaire, you referred to programmable currency in your testimony, and we had a little bit of testimony about what that means potentially yesterday. Could you give us a little more detail about that from your perspective, maybe in layman's terms? It's one of the concepts I've had the most trouble getting my head around. We know the obvious benefits from virtual currency, bringing down certain transaction fees, preventing fraud, et cetera, but the programmable advantages and what that means on a going forward basis. Could you elaborate?
I'll try my best. So one way to think about the blockchain and this ledger is it has units that you can store things in, and the current number of units in the ledger is about 1.2 quadrillion units, because each Bitcoin is currently divisible to 8 digits. There's all these units. So you can essentially use a Bitcoin transaction, a very small unit, to establish a reference to the ownership of something. And there's actually an emerging mechanism where you can store a little bit of extra data with that transaction that could be a reference to some external document, such as a financial contract or a reference to a piece of physical property that someone might own or use. And essentially this distributed ledger allows you to define definitively, I don't know if that's redundant, to determine the ownership of a unit in that ledger. And so the fact that you have a decentralized system that doesn't rely on a centralized third party to establish ownership of units in a cryptographically secure way has implications to build a lot of other kinds of applications. You could use a unit, which is on an economic basis, based on the exchange value of Bitcoin today, a fraction of a penny or even less. You could use that to store a secure reference to some other physical property, a car, or some other object. So that's one dimension, is it's really a ledger to keep track of the ownership of things, which doesn't require a traditional intermediary to verify that. The other piece is, there are currently, it's fairly limited in what it can do. There's the ability to essentially run code in the Bitcoin network. And right now, the code that you can run in the Bitcoin network is really specifically geared towards these sort of payment transactions, so sort of moving Bitcoin from one address to another address. But there are some mechanisms today even to do what are called multiple signature transactions, which allow you to have multiple digital signatures required for a transaction to complete. So a simple use case, and it's very relevant to the discussion we're having here today, would be a consumer sends money to Overstock.com, there is a payment processor like Coinbase that is helping facilitate that. And not that there'd ever be seller fraud in the case of Overstock. I cannot imagine that.
Thank you. Remember, he took an oath to tell the truth.
But you could imagine seller fraud use cases that take place, and where a payment processor would benefit from holding in escrow collateral associated with transactions. And that multiple signature transaction allows you to essentially release funds out of escrow using an approach like that. But it also can be applied in a lot of other ways. You can imagine consumer-to-consumer transactions where essentially consumers are expressing personal financial contract relationships with each other and expressing those through a user interface that are manifest and run through this network and take care of that funds flow as well. So we're just really at the tip of the iceberg on some of this. There's a lot of people who talk about even more far-fetched kinds of use cases. And I also want to yield to Fred because I know he's certainly thought about this topic as well.
Can I stop you there? I
Yeah,
do want
sure.
to hear Fred on this. But so with the multiple signatures, could you envision a scenario where, let's say, a parent could give a child
An allowance account.
an allowance,
Exactly.
but have sign-off on potentially
Any
how it's
transaction.
spent? So
or
you
set a
can
rule, transactions above $50 of value requires the parent's signature.
Right, so
you
you-
could do that today.
And could you even program it to say you can use this Bitcoin to buy a new computer, but you can't use it to go buy an Xbox? And
Yeah, that gets to the counterparty issue in Bitcoin itself, and I think there's no way to know effectively that counterparty address and what it represents.
Right.
And so unless the merchant was doing some kind of age filter and had access to that metadata, that's sort of how things happen in the credit card industry. You don't get cards issued to 12-year-olds and so forth. Those similar kinds of controls aren't in place, but certainly the signatory component would be something that could be done in an automated way. It could be a text message is sent to a parent. It could be one of the two parents plus the kid, and someone hits OK, and the money goes.
got it.
Yeah, I think there are many rabbit holes one can go down here. I think Mr. Allaire summarized it very, very well. One of the things that I think is very likely to happen here in New York is securities clearing could very well be revolutionized by this, where instead of passing around physical papers for ownership of stocks and bonds and some combination of disjointed electronic systems, it could be a single unified system that's easily trackable. I think one of the key takeaways, I think, of this portion should be that this is a very powerful technology in many of the ways that the internet in the 90s was a powerful technology. And there are many things that have been built on top of the internet. One might look at businesses like Airbnb or Uber, which are now experiencing, well, they're providing great services to the world that I personally love, and I think they're bringing great efficiencies to our economy. At the same time, they obviously have regulatory issues in some cases, but those are dealt with by the regulators specific to their industry, even though they're built on top of the internet. So I think a key takeaway here is this stuff can occur on top of Bitcoin in some cases as well, but oftentimes those will be regulated by the appropriate industry should they step into that industry. And it's important that we don't put in place guardrails which are too restrictive and prevent those future use cases at the moment, not even knowing what they are at the moment.
We were both on a panel last night that Wells Fargo hosted and had a discussion on this topic. And I think one of the concepts we had was there's sort of the Bitcoin network and the software that runs it, which actually in and of itself does not have anything to do with money. It is essentially a digital bearer instrument system with a decentralized system of trust. And the bearer instrument, the units on the blockchain, can rarely represent the bearer being the bearer of ownership of anything. And so it happens to be that Bitcoin itself has established, and the units of Bitcoin have established, an exchange value in dollars and euro and lots of other international currencies. But those fine-grained units on that blockchain really can ultimately be digital bearer instruments for virtually any product. And so it's important that we not that we realized that that layer really has nothing to do with money transmission, has nothing to do with payments, the consumer protection and payments use cases, but it's really a foundational platform that a lot of other products can get built on top of. And so I think it's a nuanced point, but one which is really critical to understand.
You mentioned Wells Fargo, so you lead me to my next question, which is how do you see, how have you experienced the sort of traditional banks, whether large or small, responding to these new payment systems that are being developed? And do you think they're going to develop, would you anticipate they develop their own systems to compete or adopt Bitcoin, et cetera? I just wanted to get your reactions, what you've seen so far, where you think it might go.
Sure.
You worked at Goldman Sachs, Fred.
Yes, but not in the traditional banking divisions, admittedly. Yes. I think they're looking at it with great interest. Frankly speaking, banks, the core competency oftentimes is not technology, it's financial services, and I think this is foremost a technology where the first major application happens to be in financial services. And much of the innovation that's stemming out of it is technological first and financial services second. That being said, the financial services part obviously is very important in establishing safeguards for that portion of it. But said another way, I think the true innovation is probably occurring on the technological layer. And that core innovation is very much this new network which has evolved, which allows for transfer and proof of ownership, to try to put it in the most generic way possible. Payments is a subset of that, without the need for a trusted third party. That obviously, like the internet did for distributing data, that cuts out middlemen in cases, and that can at times mean revenue streams for banks, which I think may be worrying based on how much a particular institution is looking into this. That being said, I think for those who support it in the early days, as Jeremy sort of alluded to earlier, we are a long way away from a world in which things just stay in Bitcoin all the time. There's going to need to be a lot of coordination with traditional financial institutions as well as regulators to get the system to a place where it's really being used for everyday commerce and it is anyway self-sufficient. I think the other sort of embedded question you're getting at is, can a bank or a corporation in some way just go and create their own version of this? I see that as highly unlikely. The reason for that is Bitcoin, I think, has experienced a great amount of success because it is an open protocol. It's open source software. Nobody owns it. Nobody controls it. And in a way that the world has never really seen before, that has allowed it to grow outside the constraints of any given organization. And in a strange way, actually has allowed it to be peer-reviewed for years in this open format that has actually given us, I think, more certainty and security than maybe any other technology. I think that if a singular corporation were to go and try and release an equivalent, it just wouldn't have those same fundamental properties and thus would not grow in the same manner.
I think coming at it from a slightly different angle, my impression is that certainly within the United States, and certainly as well within the EU and the UK, there's very little commercial interest in this market in an explicit way from established banks. I think that is largely driven by a risk management prerogative as opposed to a lack of interest in innovation or new markets. I think that the historical legacy of anonymous cryptocurrencies being used in criminal cases and law enforcement actions applied against those scares the living daylights out of chief risk officers in banks, and probably should. And so I think the reluctance not just to not get into this business themselves, but to even bank businesses in this marketplace is unfortunate. And so I think what we're starting to see, though, as world-leading investors and great entrepreneurs and really great products to start to emerge and take hold, is that senior executives in global banks are starting to pay more attention and invest time to understand this. I think the example of Wells Fargo hosting a session, which was at the end of the day about hearing perspectives from a variety of points of view and educating the marketplace as well as themselves on this is a good indicator of that kind of thawing, if you will, that's taking place. I think it's not just the commercial banks, it's the central banks as well. The leadership inside of different parts of the Federal Reserve, not just New York, but in other districts, as well as the European central banks, et cetera, they're really just starting to get their heads wrapped around this. And that's going to take time and deliberation, and ultimately ultimately involve rulemaking from some of those institutions on the commercial banks that they supervise as well.
Going from the abstract to the specific, does this revolutionize, if not eliminate, commercial banking and letters of credit? I mean, I'm wondering, from what you described, it's not surprising to me that European and major American banks would have concern if you could transfer value immediately upon receipt of goods. You've just taken a huge
the business-to-business implications, international payments, and in essentially how lines of credit work and so on are really profound over the long term. I don't think that banks are really thinking about that right now. I think they're thinking, boy, there's people going to jail. Let's not get involved in this. That's really what I think from the conversations that I have. And so I don't think people are out in front of it. I don't think that banks are not getting involved in this because it's going to undermine fee structures. I don't get any indication of that either. I think we're going to come out of the kind of risk mitigation phase here, and then I think we'll see a lot more commercial banking involvement in this as they try and get their arms wrapped around it.
Once they're not scared of crime, they're going to realize the risk to the bottom line, and you'll get a whole other wave of criticism.
I think it's a very good question, and I see real value in it. Our business is based on, we run a very thin margin business. Our gross margins are small, and any penny that we can squeeze out of the supply chain either goes to the bottom line or goes to the customer. And, we deal with letters of credit all the time with our suppliers, and to be able to get that out of the way would be significant to our shareholders and to our customers.
Just to switch topics, I have a question about insurance, and I actually sort of raised this with some of the panelists yesterday. So there have been some articles about some virtual currency firms, particularly those holding customer accounts, purchasing assurance to cover sort of cyber attacks and other kind of sort of losses to those accounts. Good idea. Do you see more and more firms moving in this direction, and what would be the effect on your businesses?
I think it's rather prudent. It's one of these things where it's very much like sort of the banking landscape that Jeremy just painted. It's one where you are dealing with an industry that, by nature of the trade, are risk managers and risk mitigators, insurance as with banking. And as a result, it takes and will take a while probably to get that industry comfortable to a point where they're willing to do these things. That being said, I think it would certainly be valuable.
Just to add to that, I think it's an issue that, from a regulatory perspective, is worth considering, which is it's a consumer protection issue, which is that when you think about a money services business, a traditional MSB, people deposit funds with that MSB, but they're really depositing into the commercial bank that sits and supports that MSB. And that money actually is stored in the Federal Reserve System. It's protected literally in the Federal Reserve. When a Bitcoin MSB receives funds, we go to the market and we convert those into digital currency, and we store that digital currency in the form of private keys. And we have a very high burden in doing so because there are potential criminal attacks on both warm storage and cold storage. And so the sort of custodial dimension to a Bitcoin MSB, I think, is quite different from a historical MSB, where the actual funds are stored by the MSB as opposed to stored in the Federal Reserve banking system. And I think, I certainly know with Coinbase, as Fred has articulated and I think has done well, and I certainly know from the perspective of our company, we take that very seriously. the investments from a technology as well as a kind of human protocol perspective are really critical to secure those. But you can imagine a world where there are Bitcoin MSBs that have billions of US dollar equivalent value in cold storage. And that would be a very attractive target for not a cyber criminal, but a real criminal. And those criminals aren't driving trucks into the Federal Reserve to go take money out, even though it's Die Hard 3 or whatever. But Die Hard 4, yeah. But the point is that these digital assets are real and are, because of the nature of this open network, instantly spendable and anonymously instantly spendable. And so there's a high burden that we're self-imposing, I think, but I think it's something to consider in the context of how states look at this as well.
Are insurance companies showing any interest? I know we've read in the press that there have been negotiations among some large ones, but since, yes, do you think this will be an attractive product to insurance companies? Can they underwrite
I think
this kind of risk?
Insurance companies will underwrite any risk depending on the price.
They're not the chief risk officers at banks.
Mr. Johnson, I'm curious. You had mentioned earlier that some of the fraud risk sort of shifts from you to the wallet companies, and I'm wondering how you think that will affect your cyber security issues.
Well, I'm not sure it will affect them because we'll still have them. I don't expect to be out of the credit card accepting business. So we know that we have millions of hack attempts every day on our site, and so we've got a huge team protecting against those, and knock on wood, so far so good. But that trust, that customer experience is paramount for our business. Once that's lost, we're in a bad place. So I don't see that changing at all. I did take a note to see if Bitcoin has a certificate of insurance that it can provide us, though. So.
Just really, for me, one last question: What do you say to the average consumer? What's your pitch? What do you tell them so that they trust you and will come bring their business to you and feel good about it?
I mean, this has really been the core focus of Coinbase and why we created the company in the first place. The idea of consumer trust revolves around a number of things. I think first it's a very visual and tactile thing. How do they interact with your service? Does it feel like it's built in a good way? Is it a good and seamless user experience? And this has been something that's getting better and better with time as web companies have been evolving. The second piece, which is very Bitcoin specific and is, as Jeremy mentioned, paramount, is how can you make sure that this is safe from a security perspective, and I quite literally mean security of the Bitcoin. And I could go into great detail as to how we manage that, but it's something that we take extremely seriously to the point where if California were to fall in the ocean, things would still be okay. Let's put it that way.
Not for Californians.
Unfortunately, I no longer live in New York. I live in California, so I would not like that. Exactly. Maybe it's not such a bad thing after all. The final piece of it really is, I think the regulatory piece actually does shine through to the consumer to some extent. I think one of the ways that we've been able to generate a lot of trust is because people see that we have legitimate backers. They know who we are. We're not mysterious on the internet. People know that I am a co-founder of Coinbase. They know my other co-founder. This is not veiled in any manner. And I think that they know that, it's publicly known that we have a chief compliance officer and that we're doing all of these things. And to some extent, I think people can feel good about the service because they know that there is some level of oversight going on in the background, and that to some extent it can be a trustworthy platform for that reason.
I'm not going to say too much, but in our description of our business on our website, we haven't launched our consumer product yet, but we sort of describe the company as a digital currency company that aims to make money easier to use, more secure, and more powerful. And we really believe that digital currency does represent an evolution in the way consumers experience money, that it will lead to people feeling like Money is an easier to use application, just like communications became easier to use in the age of the internet versus the postal service, or lots of metaphors we can use there. More secure, and we've talked about some of the benefits of a cryptography, cryptographic-based currency model, and giving consumers a sense that their financial instruments can't be stolen and used fraudulently as easily as some of the other tools that they have. And more powerful, I think, really speaks to the fact that we're building a model here which allows money to move more frictionlessly, more easily, more globally, and takes out a lot of the cost and expense and frustration that's associated with that. And those are, you could say the same kinds of things about media or communications or education that that the Internet's done for other industries, and we think that at the end of the day, that's what this is really about.
Okay. Well, look, I think it's a decent point to end, because I think we think a lot about the impacts of regulations for everything we do. And what we've often found is when regulation is too light touch in a particular industry, the firms within that area often end up competing in a race downward. You try to get more business by doing all the wrong things and having less protections in place and being the cheapest and easiest place to do business without maybe the kinds of things we expect. The flip side of that is when we have enough regulation without overburdensome regulation, we often see that flipping around, and you have a race to the top, and the companies that are doing all the right things who are more secure, safer, end up getting a competitive advantage. And then we have the firms within that particular area, whether it's virtual currency, wallets, or what have you, competing to be more secure, to assure their customers that they're hitting all the regulatory marks they need to hit. And it ends up making those firms, the good ones, more successful, and the firms that get left behind are the ones that, for example, aren't doing what they need to make sure they're not being used as a place for money laundering. So I hope we can get to that sort of world sometime in the near future. But thank you all. It was very interesting testimony from all three. I know some of you traveled quite a ways for this, and we really appreciate it, and we know you're busy, so thanks again.
Thank you very much.
Thank you.
We're going to reconvene at 2:30 for a final panel of academicians. Is that a word?
Yes, it is. A good one at that.